how you own your business is really, really important regarding how much tax you pay. Okay, most my buddy Garrett Sutton, who's a asset protection lawyer, he says CPA stands for cannot protect assets, and because he gets very frustrated because CPAs will say, "Oh, you don't need an LLC or you don't need a corporation because that's just a waste of money and a waste of time and all that kind of stuff." And I'm going, but wait a minute, you want to protect your assets. On top of that, if you have a limited liability company, you can elect to tax that limited liability company any way you want. So you could have a limited liability company that provides great asset protection, and you can tax it as an S corporation, or you can tax it as a C corporation. You can tax it as a partnership. You really get your choice on how you tax that. So having that LLC is going to be a really important thing. But if you have the LLC and you don't make any election and you're the sole owner of your business, you're going to be back on a Schedule C. So the fact of having that LLC is not enough.
So Tom, what is a Schedule C?
If you're a sole proprietor, you're an entrepreneur, you own the business yourself, and you just went out and set up a bank account. Basically, that's what you did. You set up a bank account, Anik Singal, DBA, I like coffee, okay? And so you set up this I like coffee franchise, and you start operating under your personal name, or you do an LLC, and you set up the LLC, limited liability company, and you own it 100%, and now it's I like coffee LLC. And now what you do is, now when you report your income and expenses, instead of reporting them on a separate tax return, you're going to report them on your personal tax return, which I hate putting stuff that I don't want other people to know on my personal tax return because we give it to banks and all sorts of other people. But a Schedule C basically is how you report that business. Now, why doesn't the IRS like Schedule C? Well, it's really simple. You think about your financial statements, okay? So if you're an entrepreneur, you really should be focused on 3 different financial statements. Your income statement, which is your amount of income that comes in and your expenses going out. Your balance sheet, which is your assets, liabilities, and then what's left over, which is your net worth, and your statement of cash flow, okay? Now, a Schedule C is basically your income statement, and that's it. Well, a Schedule C is really easy to manipulate because there's only one side of, we have what we call double entry accounting, which means you have 2 sides of every entry. You have a debit and a credit, which I know that's just accountant speak, but what it really means is that it balances all the time. But a lot of times the other side of that, let's say you have cash coming out of your bank account on an expense, okay? So one side is the cash coming out. The other side is the actual expense. Well, your Schedule C, all it shows is the expense. It doesn't show the cash coming out. That's a balance sheet item. So it doesn't show both sides of the transaction. It only shows one side of the transaction. Well, if you think about it and you go, okay, how do you know you've got a straight line? Because you got 2 points and there's a line in between those 2 points. And so now you got a line going through it, okay? Now, let's say you take one of those points away. Now you can put all the lines you want through that. So the IRS doesn't know if you're telling the truth or not. And so they believe you're probably not telling the truth. That's really, they don't believe a thing is, remember, under the tax law, you are guilty until proven innocent. And there's actually good reason for that. It's and I know this isn't policy time, but from a policy standpoint, look, the tax law says no expense is deductible unless we say it is. That means you have to prove it's deductible, okay? And all income is taxable unless we say it isn't. So if you have income that you say is not taxable, you have to prove it's not taxable. Well, now that makes sense, right? So on an income statement only, you have one side of a transaction. How do you prove that that's accurate? Well, that's a tough thing to prove to the IRS. And the problem is with the Schedule C, you're only showing one side. So they don't believe you, basically. They're just not going to believe that that's accurate. And they're going to come in and audit you and make sure that you're doing that accurately. Let's say instead, and this is something that all entrepreneurs, this is just basically Entrepreneur 101, right? From a tax standpoint. Instead of being a Schedule C, most entrepreneurs should probably just be an S corporation. And an S corporation, you can still be a limited liability company from a legal standpoint, still get that asset protection, but you make an election. And what it does two things. Most importantly, it gives you a separate tax return for your business. And that separate tax return is called an S corporation tax return. It's 1120S, and it's completely off of your personal tax return. Now the number comes back into your tax return, okay, because you're taxed on it, not the corporation. But again, it's a separate tax return. Well, that tax return has both an income statement and a balance sheet. So now the IRS is much better belief that you're doing it right because you're showing them both sides of your transactions. And I know that's a lot of accountant speak, but all you have to remember is don't do a Schedule C, do an S corporation. And if you get those two things, and here's the thing. So on an S corporation, remember on a Schedule C, you have to report that you have a home office. On an S corporation, what you do is, according to the IRS, you just reimburse yourself for the home office expense from the corporation. It's not taxable to you. It shows up on your tax return for your S corporation as office expense. There is no separate form to show that you have a home office. So the only way the IRS would ever know you have a home office is if you got audited. So it can't possibly create an audit because the IRS doesn't even know you have a home office until they audit you. So if you're being told that don't take a home office because it's a red flag, it's only a red flag because you didn't do the other thing that's important, which is to not be a Schedule C, to go out and do an S corporation. See, and the point is, Anik, is that these things all work together, right? So now you got your automobile expense, your home office, your not being audited. All of those things come about because, all in the same, all because you're working together.
So before we move on to talk about bonus depreciation for a couple minutes, I can already feel it. I can sense that our listeners are thinking, what the heck? I want to talk to someone. How do I do this? What do I do? Oh my God, I'm not doing this because we're only at 3.5. Like we haven't finished number 4. So I never do this for people usually, but I'm going to do this now. The URL to go to if you want to schedule a free call to talk to a tax advisor that is a part of Tom's inner network. These are the best of the best around the country. Go to Wealth Ability. Okay, Wealth, WEALTH, Ability, ABILITY.com. Wealthability.com. You'll have a little button there. You click, you schedule a call, and you'll be talking to someone who's almost as smart as Tom. Maybe, definitely not as smart, but it's pretty damn close.
No, there's a lot of people smarter than me, pal.
So well, then I want to talk to them too.
We do. We do have an entire network of accountants and CPAs that have joined our network, so that I get to train them. Yeah,
and I want to.
It's actually a lot of fun.
I do want to warn everyone who's thinking about going into this. First of all, a great accountant, there's going to be a cost to it. So please, going to get on a free call. Eventually, you have to engage their services if you want the help that comes with it. The first time I ever called Tom, he was advised. I was recommended to call him by Robert Kiyosaki's team, right? So I called him right away, and then we talked, and then he told me how much his advice would cost, and I almost fell off my chair. I was completely in shock. I thought, wow. But within 3 months of doing it, it's like if I asked you for $1 and every time you gave me $1, I gave you 7 back or 10 back or 20 back, how many times would you do that transaction with me? So it's like, that's how so a lot of people, I find what they do with accountant, and this is what I did, guilty, okay? I went to my neighborhood accountant down the street. This is someone I knew since I was a child. I mean, he's a good person. I love him. I still know him, but he's an accountant for local small, he's an good accountant for employees with a little bit of a twist in their taxes, a local doctor's office or whatever. I had gone way past his abilities, but a lot of people they discount shop, thinking that all accountants are the exact same. And I'm just here. Tom's not asking me to say this. I'm telling you, is one of the biggest lessons I learned as an entrepreneur is there's one place you don't discount shop is with your CPAs, with your lawyers, and with your wealth managers. You do not discount shop those people because, you get what you pay for.
Thanks for listening to The Fighting Entrepreneur with your host, Anik Singal.